let's also look at why banks specifically, and especially private banks. I mean, these were the holy grails, right? Everyone thought that if anything you want to buy in India, you buy an HDFC bank, you buy ICICI bank, you buy an Kotak Mahindra bank. The best trade is you buy all three. These stocks are getting butchered. How much of this selling in banks is compulsive in nature? I'm just going to, phrase the question slightly longer for the benefit of our viewers, because you're on the verge of a credit growth. NPA cycle is behind us, and yet these banks are underperforming. Whatever I've seen over the years, it should be the other way around. Am I missing on something?
See, if you look at the total foreign holding in India, and when I checked last, it was about $600 billion plus. The numbers keep on changing because the markets are very volatile. But nearly 320 billion or 325 billion out of 600 is just in the top 10 stocks. The top 10 stocks being, mostly, on the banking and financial side. And then there are some IT names, etc. as well. So, the foreigners can sell only what they can hold. I mean, what they hold, right? And they hold, really large chunks of, these names. So I think it is basically a case of, I need to cut my India exposure because of, whatever concerns. And then when I'm cutting my India exposure, I can sell only what I own. So I think that is, what is really working against the banks and the insurance companies at this point in time. But as you rightly said, the fundamentals are really in place, and this is one sector that I clearly feel that the earnings are not really going to be disappointing. We will not really be seeing earnings cuts here. We are already beginning to see earnings cuts elsewhere, like cement and autos, etc. But I doubt whether you will see much cuts in the banking side. So that's the reason why we also like it.
Bala, what 2020 taught us was that you got to buy the fear. For those who bought the fear were happy up until about a month, 2 months back. But this time around, like you yourself said, the macro dynamics are very different from the COVID outbreak time, right? You've got inflation, you've got high interest rate trajectory, the tide of course will turn. How is it that you make a portfolio which is going to be slightly protected from the macro parameters at this juncture?
So from a portfolio point of view, there are two ways, of course, you play it. One, in terms of value style, in terms of investing style, every fund manager has got either growth styles or value style. I think clearly at this point of time, while growth style has done very well, I think one should also look, not ignore the value style beyond a point, given the fact they are deeply in value, they are deep in money, but not performed because everybody was chasing the growth. Therefore, the money manager's point of view, one has to look at that. Second is, from money manager's point of view, clearly the companies that has got a structurally longer term business model, such as IT and few others, they are all structurally longer term business model with the free cash flow generating capability of the companies. I think they all will become a preference. But having said that, from money manager's point of view, while they apply this kind of principle, from investors' point of view, asset allocation will remain as key. And today, fortunately, the mutual funds are providing funds that can cater to the varying needs of the customers in the form of providing say balance advantage fund where you move the equity depending upon the valuation of the market, whether it's price to book or PE multiples. That money manager has been doing it very efficiently. Therefore, that provides one of the opportunity. Second is asset allocation funds now, of course, come in, cater to the varying needs of the customers, which are conservative in nature or moderate in nature in terms of risk getting capability or aggressive in nature. I think the mutual fund now started providing solution-based asset allocation product. Also could be a choice for the investors. And nevertheless, beyond a point, guessing the kind of outcome that could come on this kind of volatility is going to be a futile exercise for anybody for the matter. I think what could work the best actually is the discipline of investing through asset allocation methodology, whether you invest in direct equity or debt or through the combination of hybrid funds, all of them will come on the back of the discipline that every investors can bring on the table.
Looking as to what we're seeing when it comes to, the overall private banking names, the financial sectors as well, we've seen a fall of nearly 16% on the Nifty Bank from the peak, and that seems to be unnerving given its solid weightage in the equity markets. Given that, the fund holds the likes of HDFC, ICICI Bank, SBI as well, those are some of the top holdings. What is it that you're making of the current move that we've seen in some of these private banking names that have fallen flat on their faces, as now the recovery seems to be fairly gradual?
So, again, it's a case of classic over ownership of the sector. Financials as a sector has always been over owned by FIIs. It's one of the largest sector in all the broad indices, whether it's MSCI or MSCI emerging markets, all of that. So therefore, whenever they pull money out of India, it's one of the sectors which bears most of the brunt, and that is what has happened over the past few weeks. And it's very interesting at this point of time because, as I said earlier, while macroeconomics are looking quite shaky, on the other hand, the fundamentals of sector look very promising because India has gone through a very long phase of this credit cycle, which is now almost over, and therefore you are seeing clean balance sheets, well-capitalized balance sheets of these banks. Growth was about to inch up. A few fortnights, we saw numbers of over 8% and 9% for the system credit growth, and fortnightly numbers were looking very interesting. So therefore, it's a very interesting juncture at this point of time. While macroeconomics look a little bit shaky, micro of the fundamentals and the fundamental attributes of the sector look very promising. And to add to that, valuations are very reasonable at this point of time. They were anyway reasonable before this fall also. Because financials had not participated as much as other sectors in the rally that happened over the past 1.5 years. And now the 3-year trailing returns of the sector are probably in single digits, and valuations are clearly on your side. So I would say if one could look beyond the initial volatility and wait for the macroeconomics to stabilize, the sector looks quite promising in overall in the overall context. And in the sector, private banks and the large government banks looks most promising because the way fundamentals are improving and changing, and these banks have the balance sheet to take care of any incremental stress if it comes because of the commodity situation. They are well capitalized. They are able to invest in technology, which is has become a very critical factor over the past few years. So therefore, sector looks promising. However, macroeconomics could look a little bit volatile over the next few months.